You're listening to Create Wealth Through Franchising, and I'm your host, Kim Daly. In my 20 years as a franchise consultant, I've helped hundreds of people achieve their dreams of building and scaling franchise businesses to create wealth. The interview you're about to hear can also be found on my YouTube channel, where I post new franchising content multiple times per week. Please take a moment to subscribe to the podcast and to my YouTube channel at kimdaly.tv. Now, enjoy the show. Welcome back to Kim Daly TV. We have our second Daily Double for you today. My good friend Paul Moore is back for more conversation right here on Kim Daly TV. Paul Moore, welcome again to Kim Daly TV.
Hey, it's great to be here. Thanks, Kim.
For those of you who may not remember Paul Moore, Paul really has been a serial real estate commercial business developer for like 30 years. I'll let Paul tell you a little bit more about who he is. But what we plan to do for you today is really talk about the pros and cons of entrepreneurship in franchising and real estate compared to partnering with people who have a track record, who have experience, who have systems, who can guide and help you. And we'll call that in a business a franchise. And we'll call that level of support in a real estate investment real estate syndication. So we're comparing and contrasting the difference between going it alone and being partnered with people. Both Paul and I work with a similar investor. And in both of our roles, we're coming up against the kinds of questions of, should I go it alone or should I buy a franchise? Should I buy that rental property on my own, or should I partner with people and invest in a bigger property with the support of other people? So with that, Paul, before we get into that awesome conversation, tell the viewers of Kim Daly TV a little bit more about Paul Moore.
All right. So I sold my company to a publicly traded firm at 33, and at 34, I was struggling. I thought I'm a full-time investor now, but I was really a full-time speculator. And I thought I was semi-retired, and I was this high-energy entrepreneur who was looking for something to do. So I started flipping houses, and then I started flipping waterfront lots, and then I built a small subdivision and built some houses. And I realized I wasn't creating real wealth. I was just transacting hours for dollars. And so, they talk about working in your business versus on your business. I was definitely working in it. And so finally, I found a path into commercial real estate. And now I do a lot of podcasts and webinars. I've written 3 books about how investors, whether they've got a full-time job and a career and a busy life or even retirement, can offload the headaches and hassles, the toilets, tenants, and trash to other people who are already experts in real estate, and they can partner with them to make more money, more reliable, more scalable, and have a better life.
And guys, if you're on my YouTube channel, you are thinking about leverage as well. That's what this conversation is all about, right? You can go it alone. You can learn everything on your own, reinventing the wheel, crying, sweating, bleeding, trying, wasting money, wasting time, hopefully not giving up. We call that entrepreneurship. Or you can step onto that nice, paved path of a franchise with, yes, there are fees, but the fees are justified by the track record and the support and the statistical, the opportunity to hopefully be successful and to be partnered with people who know how to be successful. And so anyway, that's such a great introduction, Paul, and I'm excited to have this conversation. So where should we begin? I'm thinking that we should begin with the dreaded fees. Where do you think we should begin?
Yeah, sometimes like when I heard about syndication, I realized, that as an investor, the person running the syndication would get an asset management fee and an acquisition fee, and then they would get a 70-30, so they'd get like 30% of the profits. Sometimes that's after a preferred return hurdle. But I thought, I could probably make more money doing this on my own. But you know what? They say you make money when you buy. And our company, we hit, we ran headlong into this national crisis of lack of inventory. I mean, it's in single family homes, it's in apartments, it's now in mobile home parks and self storage. But there are certain people out there, there's experts who are getting massive opportunities that others don't get. They have acquisition teams, they have expertise, they have an ability to uncover intrinsic value. And so, the 80/20 rule. Well, I'm talking about the 80/20 of the 80/20. In other words, the top 20% of the top 20, the top 4% of the operators who are getting massive value and massive profits that much, much higher than their competition. So we are looking to invest with those folks. And when they split it 70/30 and take their fees off of it, we're still getting much, much more profit than we could ever get by working 100 hours a week each on our team and going it alone.
It makes so much sense. And I'm guessing that those investors also have a lot less hassle.
Absolutely. I mean, there's so much uncertainty. I mean, I know about a guy told me yesterday he had put a contract on a piece of property and it was covered in black mold, but he didn't find that out till after it was under contract. And all kinds of stuff out there
Costly
that you
mistake.
just, yeah, I mean, there's so many ways to make a mistake by going it alone. I mean, let's look at Warren Buffett real quick. Warren Buffett, he is the value investing king. He has spent 60 years unearthing value in places nobody else saw it. But he recommends that people don't do what he did. He knows that 99 point something percent of people would never do, forego a life to just sit poring over reports for 10 or 12 hours a day like he has for decades. And he says, go and just invest in an ETF. Just trade the market and allow the market to do the heavy lifting. You go out and enjoy your life. And that's what we're saying as well.
Yeah. And the same is going to be true in franchising, right? So we have those dreaded franchise fees, and though how dare those franchisors collect that royalty every month, but that franchise fee is a one-time fee that you're giving to the franchisor, and the Daily Coach calls that fee the cost of entry. It opens the gate to Disneyland and buys you instant access to the business plan, the ready-made toolbox, the training, the marketing, the ongoing support, the tools that are going to enable you as the business owner to not have to come to this experience, to this business with experience, but then also to be able to hit the ground running, moving toward profitability rather than stopping and trying to figure out how to make money in order to get to profitability. So that's the franchise fee. And on average, franchise fees today are probably, in my world, around $50,000. Again, that's a one-time fee. Certainly some of them are 25 or 35,000, but I have some emerging brands hitting at 65,000. So it's also a myth that the franchise fee, there's a correlation between how established or pioneering the brand is with the franchise fee. That's a total myth, but that's for another conversation. So that's the franchise fee. And then the ongoing royalty that's given back to the franchisor. Ooh, that's a spot of contention for a lot of people. Like, why do I have to give, this franchisor 8%? How are they going to earn that? It's like, listen, if we want our partner to be there, to keep growing the brand, to keep looking for new ways to keep us relevant, keep us changing, keep us adapting, it costs money. Franchisors make money from royalty. That's one of the revenue streams, very typical in a franchise. So, and how the franchisor makes money in full, it's disclosed to you in their franchise disclosure document. So it's no secret how lucrative they are. It's disclosed to you in their document. But this royalty fee on average is between 6 and 10% of gross sales collected on a monthly basis. Now, intuitively, people think, well, then I want the franchise with the lowest royalty. The Daily Coach will tell you that it's actually the opposite. But that again is for another video or another conversation. If you're intrigued by that, you'll have to message me and we can follow up on that. The lower the royalty, the more red flag in Kim Daly's mind. That's how the fees on a high level can be, quote, justified in terms of rather than going it alone and being an entrepreneur and having to figure everything out, the fees in a franchise are given back to keep growing the system. And that initial fee allows you to walk on again, open the gate and step onto that proven path versus, staring at that forest and saying, okay, I'm going to try to walk through this forest, but you got to cut down the trees in order to create a path. And you're not even sure that the trees that you're cutting down are leading you anywhere good.
It's like Warren Buffett talks about the bird in the hand versus two in the bush. You don't really know that those two are really going to be there when you go into the bush. And so that's why it's important. It's so important to go with a proven operator, which would be more the bird in the hand issue with this. I mean, look, people watch HGTV. I was on HGTV once. Joanna and Chip Gaines, they do these amazing, beautiful renovations. And sure, it's fun, just like, running your own business from the ground up. Let's say it's a restaurant. Would be fun to come up with your own French recipes and travel to France and go on eBay and get all the decorations. But are you in this for fun, or are you in it to build wealth? And how fun will it be when you are pouring all your 401k funds in to try to keep your business afloat? And how fun will it be when you're working 100 hours and your kids never see you and your marriage is strained? I mean, these are the type of things that are avoided by, hopefully avoided by running a well-oiled franchise in Kim's world. And in our world, flipping a house or buying a single family rental property. I was talking to a guy the other day, he's a medical professional, and he couldn't even get his work done at work because he had 42 units of real estate he was trying to run on the side. He said, a guy moved into my place on Monday, and he waited till Tuesday to burn it down. And he was having to deal with all that hassle, Kim. And again, in real estate, would you rather have 100% of the profits when the profits are like 5%? Or would you rather get 70% of the profits if the profits are like 20%? And have no hassle in the process. And that's why I love investing in commercial funds or syndications.
How many projects a year did your group look to try to do?
Well, we look to partner with expert operators. We talked about Warren Buffett earlier. Again, Buffett is not an operator. He's in the top 10 of the Fortune 500, but he has no products. He has no services. He doesn't produce anything. He's got under 30 employees at Berkshire Hathaway. Yet he's one of the largest companies in the world. And he partners with great operators and he lets them figure out the details. And that's exactly what we do. We're looking to partner with about 5 operators in any given year. And then we let them get all the properties. So, last year we had about 5 operators in our fund, and they had about 78 properties in the fund. This year, we've got 3 operators so far, and they've got over 100 properties that we have a piece of.
Wow. All right. So besides the fees, what's another point of comparison or contrast from going it alone versus partnership with professionals?
Yeah, how about marketing and branding? Think about it. It would be fun to name your own restaurant and get some cool French name or whatever. But, think about the branding that a franchise does. Think about the amount of work they do on marketing. Think about the goodwill from having a name like Chick-fil-A or, McDonald's or whatever all over the world already, all that credibility. And think about the location. You think you know how to figure out a location. These branding, these franchises, they probably spend millions and millions of dollars on software and staffs and all that to figure out a location for you. It's similar in real estate to that as well. I just finished a webinar today with a guy who took a $10 million asset, and now he's about to get an offer for $23 million on it. It was in the right location, it was the right asset, and that took him only 2 years to figure that, to get all that done. I couldn't have done that in a lifetime, but his staff does that type of deal routinely.
Hey, Daily Coach fans, if you're inspired by this conversation, I invite you to email me right now to explore this franchise opportunity. My email is inquire@kimdaly.tv.
It is fun to like, name your coffee shop after you, or to be, sitting and dreaming and creating and coming up with, how you're going to market to your customer. But all of that time spent doesn't make you money, nor do you know that the messaging that you're coming up with is even going to attract the customer that you're trying to attract. But when you pay that franchise fee and a proven franchise with a proven marketing plan, and a lot of times the marketing departments of these companies have, experts that have, spent time on Madison Avenue, and, other have worked for Fortune 500 companies in their marketing departments. And they are the ones coming up with the marketing. These people know customer acquisition through marketing. They know that this messaging and the coloring and everything is going to work to attract that ideal customer. It's not guesswork. And they also know that, it's not just about the marketing, but it's like, where do you spend those marketing dollars, and how much money do you have to spend? Is it $3,500 a month? Is that enough? Or is it $10,000 a month, right? You don't want to be out spending 10,000 if you could have got your phone to ring for 3,500, but you also don't want to be chipping away at 3,500 when the reality is you need to be spending 10,000 in order to really impact the market the way that you're trying to build the size of the business that you want. So wouldn't it be great to step in because you paid a franchise fee and have instant training and instant access to these ready-made tools, so that when you're ready to open your business, you hit the ground running. This marketing gets the phone to ring to attract exactly the right customer. And you know how many of those customers you're trying to attract in order to make the kind of money that you want to make, to create that ROI that makes it fun for you. All of that is a known. At least there are parameters. There's no guarantee, but there are parameters. Okay, it's approximately 200 memberships, or approximately, 100 customers to get to X amount of dollars. As an entrepreneur, you're making assumptions. You have no idea, if you can even get the customer, if you can attract that customer, if they're going to pay the price point you're offering. These are some of the biggest advantages of a franchise. Even in the most pioneering franchise brand, that you could argue they don't have a track record with their marketing. They don't have any name brand recognition. If they have even one or two corporate stores running with this plan, they have more than you have as an
That's so
entrepreneur starting
true.
from scratch.
That's so true. Do we have time to talk about a few more items?
Of course. What's next?
All right, what about scaling? I talked to a guy in Charlotte recently. He was running a little restaurant, but he was saying that he had an opportunity to open, like, I think it was going to be 100 Bojangles or Hardee's restaurants, I think it was, around the Atlanta area. He had gotten a license to do like 100. And I'm thinking, how in the world could you do 100 custom restaurants? Who could do that? Yet I know people in my own town that have 3 or 4 Chick-fil-A's and other franchises. I know one of my investors has a couple dozen of a certain pizza place that's franchised. In real estate, I mean, it would take you $1 million, or actually, let's just do exact numbers. It would take you $2.8 million to have invested in that $10 million place I mentioned a few minutes ago that we did the webinar on, $2.5 million plus. Okay, but for 50,000, my investors got into a piece of that and 78 other assets in that fund last year. And
Wow.
so, you could get, I mean, we're talking about scale, we're talking about diversification. Is that similar in the franchise world as well?
So similar. So, Paul, in a deal like that, are your investors paid quarterly dividends? Are they paid upon, the sale of that asset?
It's both. So they get cash flow along the way, and that asset is now that cost 10 or $11 million is thrown off 51,000 a month in cash flow. And so that's spread among the investors. I think that's about a 17 or 18% return on their original investment. And then in addition, that's per year. And then in addition to that, if that asset sells, they'll get about a 4 or 5 times the original money they invested. And so it's both.
Wow. How long do you hold that investment? Do you try to sell it within 5 years? Is it 10 years?
Our fund is a 10-year fund, so we have the possibility of going up to 10 years. But that I'm talking about the results on that one from only 2 years, we would expect most assets to be held between 4 and 7 years.
Yeah. And you know what else we should talk about is that equity piece. Because I want to ask you right now, like, so, if you own that property and you have the equity, then you get the tax advantage. Does an investor in
That's right.
this type of an investment fund have any tax advantage?
Yeah, all the tax advantages of depreciation, which is beyond the scope of our talk today, but all the significant tax advantages that allow someone like our former president to pay $750 in taxes in a year as a massive commercial real estate investor. All those advantages pass through, or at least most of them do, to individual investors in a fund or a syndication like ours as well.
Yeah, so the exact same thing is going to be true. Look, guys, you've heard me say this on Kim Daily TV before, right? Like the wealth in a franchise, the wealth is created through the scale. One unit, one territory, and most businesses, there's always exceptions to this rule, but one makes it foundational. Like that just gets you going. But two is where it starts to go, okay, this is getting fun. And three and more is where you really start to feel like you're building wealth, right? So, and you're right. How many entrepreneurs start a business and ever get out from underneath it to where they can scale it to a second truck or a second territory or a second location? Not too many, right? But when you are the CEO of a franchise coming in as a semi-absentee owner, manager run business where that one location never needed you from day one, where you're always working on it rather than in it, your focus is on multi-unit growth from the beginning, then you're going to be able to scale that location to 2 or 3 or 5 or 10 or however many that fits your growth strategy and your your ability to continue to reinvest. And sometimes people may ask me, but Kim, how do people afford to do that? A funding conversation for franchising is really best had one-on-one, but I'll tell you that you don't figure it all out before you ever do the first one. You figure it out as you go. The money becomes available as you grow, right? So that's kind of like a high level answer to that question, in case you were thinking that, like, I would love to be a 10 unit investor in Planet Fitness, but like, I don't have $10 million to do it. You don't need $10 million to do it. And again, this is why I have a business. This is why Paul has a business, to help bring you to these opportunities and teach you how people get it done.
Yeah, well, think about this. If I'm a bank and you came to me, Kim, to borrow money, am I more likely to, invest or loan you money for a McDonald's or Hardee's or Chick-fil-A franchise, or Kim's Kitchen, something you're dreaming about, in your spare time? No offense.
Well, okay, so we hit a little bit on the equity part. In a franchise, I'll just say it, you absolutely are building an asset that you can sell. It's a total myth that you don't own what you're building. Right now, I've been working a lot, like I bumped into a lot of Amazon people that are running the logistics, they're running trucks for Amazon. And the thing that's like so startling about the size of these businesses that some of these people I've met have is that at the end of building this, $3 million or $6 million or $10 million logistics company to deliver Amazon packages, you don't own anything. Amazon owns the trucks and the routes. And what I'm hearing from some of these people is that Amazon doesn't want you to like capitalize on the market too much, and they're cutting people off. They're like, you have too big of a business, and if something goes wrong, you're going to ruin our business, so we're not going to give you any more routes. So you invest all this time managing all of those drivers, which is a constant, interview and firing and hiring and working busy times like holidays. And then at the end of that, you don't own anything. In a franchise, if you invested that energy, what you've built is your asset that, like Paul said, has some X multiple upon exit, whether that's 2X or 4X or 8X, depends on the business, depends on the economy, depends. There's a lot of depends on that, we would talk about one-on-one, but you absolutely have that. And then of course you have the tax advantages that go along with that. And so when we look at how do the rich get richer and the poor and the middle class stay the same, according to Robert Kiyosaki, right? They own businesses. 90% of millionaires own their own business. They're not working for income. They're building cash flow. They're building assets, and they create tax shelters.
Yeah, it's very, very true. And thinking about, passing that business along, I understand that there's a massive gap right now between people who are older, 65, 75 years old, who have built this business, and people who are willing to come in and take it over. From what I understand, like in the heating and air realm, for example, there are massive number of people who are older wanting to sell their businesses, but they can't find any millennials or Gen Z people who are ready to step into those shoes. My son's in the land and timber world, and there's hardly anybody younger who's willing to come in and be a lumberjack or timberjack. And so there's a huge emergency right now for businesses like that that'll eventually just have to shut down. But in real estate, if you can develop a franchise or syndication model, you can put these assets that are all similar branding, similar websites, similar property management, same names, same colors. You put them together in a portfolio. And a friend of mine is now selling his 26 self-storage facilities all to one large institutional buyer, and they're paying a premium for this. But a lot of these older businesses can't do that. Now, wouldn't you guess the same thing is true in franchising, that you
You know
can
what? That
actually
is
package it and
so
sell it?
true, Paul. It's so true. In fact, just yesterday, my first daily double, I was interviewing a franchisor, and we were talking about the same thing, where private equity money is coming into franchising, but private equity isn't going to be interested in a single unit operator. They're interested in the guy that owns 10 Planet Fitnesses, or the guy that owns, 15 or 20 Meineke's, right? They want to be able to buy something substantial that then they can fix and flip. So that is an excellent point. An excellent point.
Isn't there an appeal for people who want to go it alone, who want to have that pioneering spirit, and who, want to put the menu together that they choose? Well, there is a place for people like that, right?
For sure. We cannot listen. Every franchise starts as an entrepreneurial business. We have to have entrepreneurs, or we're not going to have any franchises in the future. So let's not totally poo-poo entrepreneurialism. It's just a hardier route. It requires more money. It requires more grit. It requires more time. So I always love to say that entrepreneurs are in love with their business. Franchisees are in love with what their business affords. The vast majority of the people that I meet are looking at that North Star is quality of life. Quality of life requires a certain amount of money. Well, when you look at a franchise that has a predictable path to that revenue, and that has the leverage of infrastructure and a proven toolbox like marketing and training and technology that allows you to work on it rather than in it, so you get that quality of life. You're not worried that you're going to be enslaved into the everyday routine of this business. Then you're almost buying that quality of life in that franchise business. And so and you can scale to where the wealth gets created, the financial wealth gets created, all while maintaining a minimal time commitment in a business. I mean, this is why franchising wins. It's not, there is this kind of I feel some people look down, like entrepreneurialism is where it's at. And sure, again, we need entrepreneurs, but there is true wealth to be created in franchising if it's done correctly, and if you're partnered with the right franchisor. And I'll leave it on that note. This is why the Daily Coach has a website, has a YouTube channel, has a business, is to educate people about what are those businesses. They're not the ones that you're thinking of when you're looking at Entrepreneur 500. They're not the ones that most people have a passion play for. That doesn't mean you're not going to love your business. You're absolutely going to love it. What you're really going to love is what it affords you, money and time.
It's absolutely true. And there's a book called The Coffee House Investor, and it talks about how, we could go in and try to repeat Warren Buffett's strategy of spending untold hours trying to mine value out of these massive, 10K reports and all this, trying to figure out where the value is in stock. Wouldn't you rather enjoy your life? Wouldn't you rather enjoy your family? Wouldn't you rather have your kids know you growing up? And that's why we like the possibility of investing in a so-called franchise in the real estate realm. And Kim, I can see that we are really, really on the same page here. So I have loved this episode and so glad to be here with you today.
I'm so happy that you suggested it. How fun. I hope you viewers have enjoyed this conversation. We're going to leave Paul's information in the description below. So if you are intrigued with the idea of investing in this franchise for real estate, you could reach directly out to Paul. And of course, if you want more information on investing in a franchise, the Daily Coach absolutely wants to be your daily coach. Paul, thank you so much for being my guest today.
Hey, thank you. It was a great honor to be here. Really, Kim. Thank you.
If you found this inspiring, please contact me at inquire@kimdaly.tv. My consulting services are totally free to you. Again, that email is inquire@kimdaly.tv. I can't wait to hear from you.